Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this Thursday, October 6th. So we have one more day in the trading session left tomorrow, and overall the markets were under pressure today. So initially you were holding some bullish formation, and this still technically could be consolidation. However, keep in mind this fake print on the daily S&P did not happen. We have not filled this technical gap, so therefore that makes me think and stick to our original thesis that we're going to see this gap filled before the markets can potentially move higher. So with that understanding in mind, the S&P is down today by minus 1.04%. This was kind of an interesting day. We did lose one of our day trades, so unfortunately that's just how some of them happen. You can't always win them. But this is the intraday action of the S&P. So this is your gap from October 4th, yesterday, and then 2 days ago, you rallied up. This is your next gap down, and then you had a little bit of rally, new high. And then this morning you gapped down, rallied up, made a new intraday high, but failed to take out yesterday's pivot high. And then you started trading down, and notice what signal you got. As soon as you got this intraday topping tail at the high of the intraday price action, the markets have been trending lower ever since. So the big question is, I do think we're going to stop at this support level over here for maybe a short little intraday bounce, but I do think we come down to fill that technical gap to the downside. Now, if we look at the daily chart of what's transpiring, just keep in mind this gap needs to be filled, which I do think it will fill. But overall, the pattern of this, the long-term trend is still technically down. And the longer we trade below this COVID trend line where you broke this clear pivot over here and over here, the more likelihood of you're going to trend much, much lower in the near term. And keep in mind, many people are still forgetting that we triggered this head and shoulders, this left shoulder here, this right shoulder, this head, and then this right shoulder over here. You broke the neckline, you've confirmed below without a question, and we have not fulfilled that downside target yet. So if we just had to do a quick rough measurement, that takes us to about 344 on the charts, which would be right around there. And you can see that's a major pivot, a little bit of a breakout pivot zone. So clear resistance will be lying at that point. But overall, this pattern doesn't have to go up to touch resistance. We could be at the stages here where we've run out of momentum. The market's just looking like it's bullishly consolidating, which it's done all year multiple times. It did it over here, breakdown, so it did it over here, and then you broke down, did it over here, breakdown. So the market loves to bullishly consolidate in a way before breaking down because it sucks in new money as people don't know how to read the overall trend and where the massive technical support lies. So with that understanding in mind, there's the potential, especially when you look at what is transpiring in the bond market and the currency market. So I'm still super bearish. Obviously, we've had a massive technical bounce. We've unloaded some of our longs. We even unloaded a beautiful one today, Canopy Growth. Amazing job. We have been prepping and telegraphing this trade now for the last several months. And we've been in and out of Canopy a few times now. But let me just pull up this CGC chart. Look at this massive pop late in the day. You can see a beautiful 10, 20, 30, 40, 50, 60 minute surge. But basically the bulk of the majority came in the 20 minutes over here. But it's a beautiful surge. You're at a technical gap fill, which you filled. I did not get off a short. I did want it to potentially intraday short this one, but because you have this massive downsloping trend line, pivot to pivot, and then you just hit that to a T, major pivot. You also have this bearish bear flag pattern, which you've triggered and broke down, which you've retraced to, and then you had a technical. That was a 3-factor setup for a short trade, which I wasn't able to hit, but we are popping in the after hours here, which I may start to pick up a little bit of a short here, which, forgive me, I'm just entering a short trade as we speak in the after hours for Canopy, since I do like that level. So 388, let's do 1,000 shares on Canopy. Good till extended market, sell. Okay, so I did short Canopy Growth. I just got filled at 388. day trade short, CGC, 388 after hours. So we're short CGC in the after hours, but nonetheless, let's just flip back to the SPY just to see what's going on. So the S&P did finish down on the day today. Now, what we have to keep in mind, and why I'm so kind of bearish in the short term, is this big technical gap is staring me in the face. When you look at oil, let me just erase some of these and go back to a one-sided chart. So when you look at oil, oil's actually had a 4-bar surge right into resistance. Now, tomorrow is confirmation day for oil. What I could potentially see happening is oil having a power surge in the morning and then reversing off of that massive resistance line over here. I just do think oil is a little bit slightly too extended in the short term for it to keep climbing. Yes, OPEC cut, but I think this is going to be a big rug pull in the energy sector. I'm not really buying and taking into account that OPEC cutting 2 million barrels a day should affect it. I think the demand side from the Fed is certainly going to kill off a lot more than 2 billion barrels, especially when you factor in this as a global recession. I think there's bigger downside in the energy markets to come, and I do think the energy bulls, yes, there is a long-term viable case, but I just do think you're extended in an extended state into resistance. I do think that the energy sector will pull back nonetheless. Even if we look at XLE, for instance, you can see XLE is at that similar point, also trying to break out of this downsloping or this upsloping wedge pattern. So with that understanding in mind, XLE has had a 1, 2, 3, 4, 5, 6, 7 day bar surge into a technical gap. You have another technical gap just up here. So there is the potential that we float up to this 83.26 before seeing a pullback, but I do think energy is going to see a pullback very soon. If you look at the weekly time frame, this is a classic inside bar bearish pattern formation. The fact that it's been multi weeks now, when arguably the economic conditions are still deteriorating due to the fact that the interest rates have not had a chance to work itself through the system yet, I do think that this inside bar bearish pattern, just like how oil was trading, is going to play out to the downside and catch a lot of energy bulls off guard. So if we look at the USO as well, I think it was on the USO, actually no, it was WTI. Let's go WTI just to show you that similar pattern that which was happening. So if you look at the WTI weekly, for weeks here you had this massive reversal candle, and basically these two reversal candles here. You traded 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks. You failed to make a new high but sucked in a whole bunch of new money, and then the pattern just broke to the downside in oil. Yes, we're at an extremely different level on oil, but nonetheless, if you look at how far ahead all these energy plays have gotten, like Exxon, these companies are trading at lofty levels, and I do think that the global recession won't be really any different in the sense that energies typically see massive downside. And when I pull up my sectors chart, I just want to go through financials down, energy up, down. Utilities are the big one I'm going to go over, but every major sector confirmed the downtrend today, except for energies. And like I said, there's not a lot of time where all sectors are red and negative, but energy staying up. Think about what sectors use the most energy: utilities, real estate, builders, transports, the Dow. So those four sectors are what use the most energy commercially. So if all those four sectors are breaking down and having nasty days, it's going to factor into the energy market sooner rather than later. If we look at utilities, utilities is an interesting, I did prep you members last night with an intriguing chart. You should have expected downside today, which is what I expected as well. And we were expected downside because of that fake intraday print on the dollar, as well as with what the price action of utilities was showing us. So utilities falling today down 3.31%. Utilities lead the market up, and they also lead the market down. The fact that utilities now, if we look on a weekly chart, is actually breaking this COVID trend line over here to over here, that is not a good sign for utilities, and that is showing that there's a lot of underlying weakness even in the defensive sectors. So when a defensive sector is falling more than the actual indices itself, you want to take note, and because that is extremely, extremely important. And if utilities keep breaking down, which they're looking to a failed recapture of this massive trend line, that is certainly going to weigh on the markets. And you mark my words, these S&P 500 is going to see some sharp downside to play catch up to this utility sector. Even if we look at real estate's another leading or lagging indicator, but it definitely has a massive, massive role in the economy. Losing its complete bounce level and now making new lows. That is extremely bearish to see real estate. The fact that the S&P is still holding around, but sectors are now making new lows, you better take note of this bounce, because people are dumping and people are selling, and the big sectors are starting to roll over. I mean, even the Dow, yes, it's holding up better. It is still holding up, but it's also a smaller basket. You look at healthcare is starting to roll over in a way. Builders are slowly starting to fade. Financials are fading. So again, when these sectors start to fade, and if you look at broker dealers, which is a leading sector for the overall economy and stock market liquidity flows, look at XBD. It's into resistance. You've had this big two-bar surge. You got your retrace to the breakdown zone, but now this level is not going to hold again when you come back down to test it. But keep in mind, utilities lead this market higher, lead this market lower. It is the big signal. Just like when we tagged resistance up here, it was the exact same day that the S&P topped over here as well. And basically you can see that I've marked the different points in the market. You know, early in April, SPY started next down like April 29th, while the XLU rallied. So generally the XLU rallies as the SPY is about to make a top. But when you start to see XLU falling and the SPY holding, the SPY is going to follow XLU down in more scenarios than not. Let's just take a look at natural gas. Natural gas price action did finish slightly negative, but pretty much a flat session, failing to hold the gains that it did see earlier in the day. Taking a look at the QQQ, let's take a look at the daily chart of the QQQ. So I want to touch base on the Russell, the IWM, the Russell 2000, and then the QQQ. So the QQQ actually made a new high today, and the importance of this reversal candle is that you made a new high but failed to close above yesterday's previous high. So that is slightly bearish in the short term. I still think that if the markets want to go higher, you have to come fill this technical gap, which is about a call it a 2.4% drop on the Qs. The IWM is kind of in the same boat. It did finish down today, down 0.5%. Also, the interesting thing is that I did get word that we got a little bit of a fake print on the IWM at 183.92. I didn't get it, so I don't see it on any of my charts, but another trader that I know did get the pattern apparently. But the IWM made a new high, kissed that 25-day moving average as resistance, and bounced and reversed to the downside. Now, what is bearish about the IWM is this trend line over here. Let's just actually go to the intraday. The fact that you could not hold this trend line connecting your pivot to your pivot, this is your impulse move breakout. You retrace, recapture the trend line. The fact that you could not confirm and hold above that trend line is extremely bearish in my point of view, and this is not bullish consolidation happening on the hourly chart anymore. This is choppy inside bar bearish consolidation that is likely to trend lower. So these reversal signals, the fact that we made a new high and reversed sharply, is what really you should be paying attention to, along with other important sectors starting to roll over. If we take a look at gold, gold is just having a pause day, consolidation, so nothing really new to report on gold. If we take a look at silver, silver's also basically just pausing and consolidating. I would still hopeful that silver comes down to flush, potentially with some market weakness we may get that. Let's take a look at Bitcoin, BTC USD. So Bitcoin again hasn't confirmed the breakout, but still holding this key trend line above your 2017 high. So we're still long Bitcoin at this point in time. Nothing's really changed from yesterday's analysis. Let's take a look at the DXY. Very important. So yesterday we alerted you late in the night that we got this fake print. So this actually did not happen. And I had to make a chart because generally intraday prints, intraday fake prints are extremely powerful in the short term. It's kind of like a smoke signal that the markets give from one to another. And this print never actually happened, meaning that the price, someone put in a massive currency orders and demand for dollars, and it triggered this level all the way up here. But it actually, the price never went up there on this candle. It's just a fake print was registered through the system. Now, generally when you get a fake print, price action is drawn to that print. And this is intraday fake prints. Price action is drawn to that level like a magnet. And it looked like we were starting to break down. And even if you analyze all time frames, you know, if you go up to the 8-hour chart, you could see that this, let me just figure out where I am. There we are. So you could see that this was your fake print here, and it looked pretty nasty even on the 8-hour chart. If you go to the hourly chart, anyone trading this using intraday action, not being aware that this price action didn't happen, would have assumed that this is extremely bearish price action in the dollar with a long reversal tail like that. That's why it's so important to really know your price action and where your key levels are and what candles are actually transpiring. And I just so happened to be watching intraday, and then I picked it up on the daily chart. So you have this big reversal on the intraday charts, but on the daily chart you had this pretty big gap down where basically your price action was down here, your gap was from here, so you had a big gap window open, and that's how I picked it up that it was a fake print. So again, a lot of you will gain experience if you start trading more frequently and watching the markets from the day to day, but nonetheless, we prepped our members. We were expecting downside in the markets because of this dollar price action and drawing the price to that level, and that's exactly what you got. The dollar exactly rose to that price level throughout the day, and then it actually broke through. And the importance, let's just go to the 4-hour chart. So the importance of this dollar breakout is that you've broken out of this downsloping channel, confirmed, but now you're looking to still retrace back to this original breakdown line. If the dollar can capture this level and confirm above there, then I think the dollar goes back to test the 114 level. And that's going to put a massive strain on the markets any which way you think about it. So just remember, if the dollar starts consolidating here in a tight range, the likelihood of it breaking through this orange trend line is very probable. So a good thing to watch, and what I'm kind of expecting for, is even if you look on the hourly chart, do you keep this tight bullish consolidation range maybe for another 5 to 8 hours, and then you have a potential test of this resistance? But if you can keep this range tight without falling too much, you have a great shot at breaking through this level and recapturing that trend. And that would put into perspective why there's going to be a potential pullback in energies that should coincide with the dollar moving up. And then when you look at the 2-year yield, which is the yield rate where the federal fund has to get to. So the 2-year yield has actually broken out today on the 4-hour chart. Now I have to assume with this confirmed breakout, well, mind you, it's only confirmed in 42 minutes on the 4-hour chart, which is a decent time frame for a trader and a sort of swing trader. So confirming in 40 minutes this breakout, as long as we can hold above this 4.225 level, you have to think that this is minimum going to this gap fill around 4.28. The markets are not going to like the fact that yields are going to likely get to this 4.28%. And who's to say we don't stop it there? I could definitely see the yields pushing and actually testing this double top zone, so to speak. So that's kind of my forecast right now. Yields are looking extremely bullish with a potential confirmed 4-hour breakout happening in 41 minutes. That's kind of what I'm going to be watching over the next basically 40 minutes. If we confirm this downtrend, then I do think that the SPY sees yet again another down day tomorrow, potentially to that gap fill. I don't think the markets have priced in yet again yields being this high, because not long ago yields were collapsing and falling and markets got a little bit of a technical bounce, and now yields are back on the rise, as if the Fed pivot or pause was wishful thinking and it was a classic little bull trap. So this is why we're so nimble in the markets, because yields have been going through crazy swings, crazy up and down movements. I mean, the fact that you have basically in a couple days the yield market changing another 6.32%, that's pretty much the whole freaking bounce that the S&P got. So if S&P bounced 6% because the yield market was much, much lower at that point when it bounced, now yields are basically back up 6%. One would have to assume that we're going to wipe out that 6% gain that we just got on the S&P, because yields have wiped out that basically that 6% loss that they've just fallen. So this is the crazy dynamics about our currency markets and our yield markets. If you're not paying intraday to the and daily to the overall changes in multiple different markets, you're going to get annihilated as an investor. And this is why there's so much volatility in the stock market, because there's so much volatility in the yield market. And when there's so much volatility in the yield market, there's so much volatility in the bond and currency markets. So let's just keep our heads on a swivel. Congrats on that CGC trade once again. Let's just see how it is doing in the after hours. So CGC has had a slight pullback off of that level, a little bit of a reversal in the after hours. Again, we're in at, what did I issue the alert for? 388. So we're actually in the money on CGC right now, so to speak. But I think we can get a pullback, especially if the market sees some pressure. I think we get a pullback probably back to this 338 level is where I see some big critical support, intraday support. So let's continue to take these markets day by day. Great job on that trade. And let's just continue to monitor the yields, continue to monitor the dollar, and we'll just take this market day by day. So congrats on the